There seems to be a lot of uncertainty in the marketplace about the direction of the market. What I would like to do now is just look at a couple of indicators and see what they are telling us about the trend of the stock market. Let me say two things first, though. First of all, the momentum works because it depends on the business cycle. Markets reacts to economic trends, and economic trends, once they're in place, they last for at least 1 to 2 years. That's why momentum works. Then the second example that I would like to discuss is a very simple model that helps to reduce the risk and the volatility of a portfolio. This graph shows the stock market, the S&P 500, from 2000 to last week, and is a monthly chart. And what you see is two lines, the blue line and the green line. Most people focus on the green line because it's the daily to daily or monthly quotes of the stock market. But to me, that's noise. That's you're wasting your time trying, especially if you go down to a weekly or a daily basis, try to forecast all these wiggles. What I think is important is to focus on the blue line. Look how smooth it is. It goes up, it goes down. Once it turns, it keeps on going up. Here there is some hesitation. Here there is some hesitation. But look at the trend. The trend is mostly, once it turns, is up for a long, long time, again, to reflect economic conditions. For instance, here there was a recession. So from 2000 to 2002, 2003, this was the tech bubble, the market weakened. Then there was the expansion. This is the 2008, 2009 recession. There was a growth recession in earnings, and here there is again another growth recession in earnings. But the bottom line is, the point I'm trying to make is that, look, you follow the blue line. Follow the blue line. Once it turns up, it stays up forever. Forget about this green noise that seem to confuse the whole idea. Of course, one has to consider these turning points here and here, and this is the indicator that I'm going to show you next. This indicator helps to fine-tune the direction of the momentum, and is the percent of stocks above the 200-day moving average. This is the green, very noisy line. But if you compute a moving average of this monthly data, you get this blue line. Okay, this has a tremendous amount of information. 2 points are important. When this number of stocks above the 200-day moving average rises, obviously momentum is building up. There are more and more stocks going up and rising above the 200-day moving average. So this trend here is very bullish. This is very bullish. This is bullish. This is bullish. The interesting feature of this chart is that when the graph turns, the blue line turns, it doesn't go back, at least for the last 20 years, it doesn't go back until it goes above this level, which is between 60 and 65. So the turning of this indicator up is bullish and tells you that the momentum is strong and is improving and is going up. The other useful thing about this indicator is when it is above this red dotted line, there is strong momentum. The market is going up. The time to worry is when this gauge declines and goes below this level. When it goes below this level, when it goes below this level, and when it goes below this level. Let me show you now this graph together with the S&P 500 and see how we can use it and fine-tune the direction of the momentum of the market. This graph shows the S&P 500 for the last 20 years, and also the number of stocks, the percentage of stocks above the 200-day moving average. Before we go, though, into the relationship between these two, I think it has to be, what I think is fascinating is how this declines here and the decline here And this decline coincided exactly with a slowdown in the business cycle. This was the slowdown of 11-12. This is 14-15, and this is the slowdown that started in 2018. So the market knows, I guess that's the bottom line of what the economy does, and that's why this knowledge is what creates the momentum. So, but anyway, how do we use now these two charts together? Well, of course, what we want to know is this turn up, is it going to last or not? This turn up is going to last or not? This turn up is going to last or not? Well, let's look at this chart below it. What you can see is the momentum is increasing. So the odds are that this is a real momentous economic momentum improvement in growth, both in the economy and in earnings. Then the momentum of the economy is going to last through all these periods, and then suddenly the market loses momentum. And guess what? The blue line curves and the green line goes below the moving average. When will the blue line turn up? Well, look at this point here. Finally, this blue line rises, saying now the market is sensing that there is an improvement in the economy. The number of stocks above the 200-day moving average increases, and as long as this curve rises, then you can rest assured that the probability that this is the real bottom of the market is there. The market is going to be strong through these years. Then there is the slowdown in the business cycle. Again, reacceleration with the market picking up again. Momentum up, then the slowdown of 214-15 when people started possibly talking about the economy. And of course, what you see here, as soon as the line goes below the dotted line, you see that there is an inflection point both in the market and in the blue line. When will the period of uncertainty be over? When this blue line turns around, starts going up, and this coincides exactly with the bottom of the market. And the market will go up as long as the momentum is strong. But look what happens here in 2018. Well, the market knows that there's going to be a slowdown in earnings. So at this point, if you draw up, the market has another inflection point. The blue line has an inflection point again. So what is now this curve telling us? Well, no indicator is perfect. We are really dealing with probabilities here. But look where the blue line, the green line has been. And now has been strong and risen to 60, 65. And now the blue line is beginning to turn around. And so what this is saying, that what we see here, this now rising blue line, so really another up leg in the market, is for real. I would like to see a little more rising in this blue line, but I would give a good 60 to 70, even 80% probability that what we see here is another resumption in the growth of the stock market as we experienced here, we experienced here, we experienced here, and we have experienced here. When is the time to worry? Is when this blue line rises above 62 and then it turns down like it did here, 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 and here. Well, I hope this helped, but I want to show you another example of momentum that really is so simple. Just hang in there. This is another example of momentum in action. And what this is a model based on the following rules. You take the S&P 500 on a daily basis, and then you use the 200-day moving average. At the end of the month, you use the following rule. If the S&P, only at the end of the month though, the last day of the month, if the S&P 500 is above or at the 200-day moving average, you buy or you hold your current position. You only sell if the S&P 500 at month end is below the 200-day moving average. Portfolio Visualizer allows us to test this idea, and this is the result of the simulation. since 1985, by the way. We run this model. And this is the buy and hold investing $10,000. Is 11% annual rate. This is a standard deviation, which is a measure of volatility, almost 15%. The best year produced 37%. The worst year lost 37%. And the maximum drawdown was 51%. Following this timing rule that I just mentioned, the return has been slightly more. That's not really an exciting return. It's almost like buy and hold. But what this model's momentum-based model do is that they provide an advantage in terms of volatility of portfolio, 1139 instead of 1482, so a substantial decline in the volatility of the returns. The best year is the same. The worst year is cut in half, more than half. See, it's 14%, when instead here you lost buy and hold is 37%. And then instead of losing 51%, this model based on the above or below the 200-day moving average, only maximum loss is 24%. So this is a big advantage of using momentum. Allows you to use these models with substantial reduction of risk. Let me show now the chart. This is the chart of the model. The brown chart is buy and hold. As you can see, you have substantial declines here, substantial declines here, and this is the performance. The blue line instead, based on this rule of the end of the month rule, you are not going to outperform the market. For instance, here you were way below the performance of the market. But what allows you to do, but you see, you don't lose money. You don't go through the trepidation of losing 30-40% of your capital like here and like here. And instead it's more a steady growth. And here the model started to outperform slightly the buy and hold strategy. Again, the issue is that momentum-based models, you cannot say that they outperform greatly the market, but what they do, they reduce substantially the risk of your portfolio. This simple presentation really is just to give you an idea, to make a point that momentum is the simplest tool available to investors to recognize the market trend. And the reason it works is because momentum is influenced greatly by the trends in the business cycle. Much of what I discussed here is in my publication, The Peter Deck Portfolio, which is published every week, and in my 3 books. These 2 books here, The Easy Ways to Beat the Market and Investing Wisely, discuss all sorts of simple models based on momentum investing. This one examines, which is both commissioned by McGraw-Hill, studies the trends of the business cycle and how they impact as the value of asset prices. Well, thank you very much for reviewing this presentation. I hope that helped you a little bit understanding the relationship between momentum, business cycles, and the stock market. Until the next time, thank you very much. So long.